Good morning, good afternoon, and good evening, everyone. I'm Jie Li from the School of Management at the University College London. So welcome you all to today's Luohan Webinar. It is our great honor and pleasure to invite our distinguished speaker, Professor Lin William Cong from Cornell University. Let me briefly introduce you about Professor Cong. Professor Cong is the Rod Family Professor of Management and Professor of Finance at the Johnson Graduate School of Management at Cornell University. He's also the founding director of the FinTech Initiative at Cornell. His research expertise covers several key areas, including financial economics, information economics, FinTech, the digital economy, innovation, and entrepreneurship. His research has been widely published and cited in leading academic journals, such as the Journal of Finance, the Journal of Financial Economics, Review of Financial Studies, Management Science, and IEEE Computer. Professor Cong's work is impactful and has been gathered in significant attention from international media outlets such as CNN, Bloomberg, The Economist, Forbes, and the Washington Post. So today, Professor Cong will be presenting his latest research in the field of corporate finance and AI. As AI technologies has become increasingly sophisticated, many enterprises are turning to AI for design support, employing it to forecast financial performance, analyzing financial reports and market sentiment, and evaluate risks. So for the AI to truly be effective in these complex decisions, it must be both intelligent and reliable. Professor Cong and his co-authors have developed a framework named AlphaManager, which integrates AI and machine learning techniques with a data-driven, robust control approach. This framework provides us with innovative solutions to the challenges of complex corporate design making. Professor Cong's presentation will begin with an overview of the research agenda on AI for finance, and then followed up by an in-depth discussion of the paper entitled AlphaManager, a data-driven robust control approach to corporate finance. As you may know, since 2018, Professor Cong and his research team have been at the forefront of applying AI in finance. In particular, developing the first large language model for financial academic research. Professor Cong will have a dedicated 1-hour session with us today. If you have simple clarification questions during the session, please feel free to unmute yourself and ask. For more detailed and in-depth questions, we will kindly request if you could hold them until the end of the talk for 10 minutes when Professor Cong will centrally address them. So without any further ado, please join me in welcoming Professor Cong.
Thank you very much, Jerry, for the kind introduction. And it's a great honor to be with Luohan Academy to present at the webinar again. I think I did this a couple of years earlier. So today, I hope to quickly introduce a kind of research agenda that led to the particular paper I am going to delve into details about. And that's about building AI models for finance. And we've seen many applications in asset pricing in investment. And today I actually want to kind of share with you what we've been doing, especially with my co-authors, Murilo Campello and Luofeng Zhou, on applications to corporate finance. So without further ado, let me just provide the background, right? I'm going to make a strong claim that modern AI for the past 15, 20 years is really about goal-oriented search or goal-oriented kind of algorithmic development. So if we think about previous or conventional AI and machine learning applications in finance, they are typically used to handle features of big financial data, right? High dimensionality, non-linearity. We use lasso ridge, elastic net, simple neural nets, trees, so on and so forth, to capture interactions, so on and so forth, to deal with the low signal to noise. We pay a very careful attention to auto sample types, so on and so forth. But the applications so far have been about training true examples, namely supervised learning, right? Historically, you observe X and Y, try to figure out the relationship, learn from historical data. And mostly we rely on some statistical properties, especially in prediction tasks. I think more recently, we try to incorporate more economic structure to the machine learning techniques. But they're still typically off the shelf. And even for unsupervised learning, right, that's mostly relying on statistical properties of data. With large language models, you've seen a lot of NLP actually before that, right, word embedding topic models, but they are mostly used for textual analytics. What we want to do is, can we learn something from these larger models, especially in NLP, but at the same time apply to non-textual financial data that we have? To kind of prepare for that, I have to make this claim, right? And when we think about modern AI, when we think about intelligence, we typically associate them with human intelligence, right? The neurons are trying to mimic how our brain functions. And there are many instruction-driven automation programs that are very sophisticated and powerful, but we typically don't view them as intelligent. And if you look at, for example, Stanford HAI's Center's definition of AI, right? The ability to learn and perform suitable techniques to solve problems, to achieve goals, right? Appropriate to the context in a certain ever-changing world. So it's this end-to-end solution provision, right? You can give them a complex problem. You don't have to provide step-by-step instruction, but the model somehow solves it. And how do these models solve the problems we have at hand? We typically enlarge the modeling space, making it very powerful in extracting, representing information. And then we search in that large modeling space for a good solution to a complex problem. And in a way, I'm going to argue that there are three directions, not mutually exclusive, on how AI has been evolving, right? We're building larger models. We're using greater computation. And it's no longer taboo to use large models, because now we do realize larger models can actually do quite well, even auto sample, double descent, double ascent, whichever you call it. We are gathering more data, because for larger models, we need more data, but sometimes we don't have a lot of data. That's where pre-training, transfer learning, self-supervision, all these would transfer learning coupled with self-supervision would all come in to help. And more importantly, that's perhaps emphasized less, is we're also trying to come with better algorithms. We're not doing a brute force search, right? For example, when we talk about AlphaGo, we're not using supervised learning to search over all possible strategies. We are search in a clever way. So I'm going to emphasize the third point as our innovation here. And one way to improve the search algorithm in this large modeling space is through reinforcement learning. It's effectively a heuristic search. The idea is, okay, fine, we don't know the world or the environment perfectly. So I'm going to take actions and see how the market fit back to my action. And then I fine-tune my action, right? So it's essentially a approximate dynamic programming or stochastic control approach, trial and error, right? Multi-arm bandit problem. And some of you have heard me talking about this at other occasions. So I apologize for the repetition, but I think it's important to emphasize this is one heuristic way of searching for a good solution in a large modeling space. And that's what I'm going to focus on when talking about corporate finance. Now, just for illustration and also for providing a little bit of background, in an earlier paper, right, we were actually building this, I believe it's the first large model in finance with millions of parameters for portfolio management. And over there, we're trying to solve this portfolio management problem, which is typically done through a two-step approach, right? First, you estimate the expected returns, so risk premium, pricing kernel, and then you construct a portfolio. there are many reasons why a direct constructional portfolio could work better. In particular, in the typical first step, there's a large estimation error, and the two steps are not aligned in their objective. If I'm doing a long-only portfolio and I estimate some assets return to be super negative, it shouldn't be relevant for my portfolio. I care about it if I care about asset pricing per se. But with limited data, limited statistical power, I want to concentrate what I can do on assets, on moments, on characteristics that would matter for my portfolio objective, which could be arbitrarily given. Right. So earlier attempts to solve these direct optimization problems face obstacles because they were not handling the high dimensionality or nonlinearity in financial big data. They don't incorporate interactions of the agent's action with the environment, so on and so forth. So in that particular study, what we were trying to do is to apply deep reinforcement learning. That's what DRL stands for, to portfolio management problem. And without boring you with the detailed point-by-point discussion, I'm just going to ask you to look at this architecture here. Right? We basically take the time series information, high-dimensional time series information for each asset I. That's X1 means asset 1, X2 means asset 2. Pass them through a transformer encoder. Right? Transformer is the T in ChatGPT. And that's one example of sequence representation extraction module. What it's doing is essentially extracting information in time series in a very powerful way and representing them in some abstract space, right? That's R1, R2 through Ri with I assets. And then we also introduce a cross-asset attention network. That's just taking the self-attention network used in transformer or in all these large language models, but apply it in the cross-section. Because we do know there's rich information in the cross-section of asset returns. So we do that. That's not too tricky, but it wasn't done before. And then with all this information extracted, we have to say, what is the economics, right? So far, it's just statistical operation or data science operation. Once we represent all this information associated with each asset using, let's say, S1, S2, we call those winner scores, we can rank assets and construct portfolios. And here, reinforcement learning comes in, right? I construct portfolio. You tell me the objective. If it's working well for that objective, I search more in that parameter space. Otherwise, I search away from that parameter space until the model converges. That's the training process. It's trial and error, right? Approximate dynamic programming approach. And you can give me any objective that can be written as cumulative reward. So it's very flexible. You can put in trading cost, transaction cost as well. That's not my main focus for today, so I'm just going to show you one table where the objective is monthly rebalanced portfolios Sharpe ratio, right? Annualized Sharpe ratio. Auto sample, what I'm reporting is auto sample. It's consistently above 2. If you try harder, you can get higher. Bigger than Q10 means excluding small stocks. You can do all types of economic restrictions. You can control for well-known risk factors. The XX alpha annualized is still over 13% consistently. And we did that back in 2018, 2019, 2020. And over the past few years, one benefit of not being able to publish the paper quickly is that you accumulate more data. So we had a true auto sample data for the past 5 years. And the lower panel is just showing the performance. It's still performing well. Of course, you can add alternative objectives such as managerial compensation or minimizing the portfolio variance subject to never losing 80% of the funds, right? In order to avoid a run. So it's very flexible. That's heuristic search. An alternative that is a bit more interpretable than deep learning model would be using trees, right? Regression and classification trees. And they are typically more interpretable. They are not very large, a few hundred parameters. And there is also a motivation for exploring them for AI applications in finance, because they're related to human intelligence. And in fact, from quotes in The Art of War, there's this concept and strategy of divide and conquer. That's exactly what trees are doing. However, conventional trees are not designed to handle panel data. They are essentially static models. And they use statistical objectives. They don't use economic objectives. And interpretation is not always available, right? Because if you look at single tree, it tends to overfit because there are less and less data in each child node as you grow the tree. And to deal with that, we typically use ensembles, right? Random forest boosting and all these. But these are superimpositions of many models. We actually lose interpretability. So the idea in a series of articles my co-authors have been working on is to introduce a new class of tree-based models that can handle panel data. And then we use global economic goals, economic criteria, such as maximizing Sharpe ratio or minimizing prediction error, minimizing tax loss, right? To train the model so that we can just use a few single trees to get to results that are comparable to deep learning models, for example. And these are still very interpretable. So, here I list a few examples along that line of work. It's not something that computer scientists have been exploring. I personally find it quite promising, right? You can use it to create test assets. You can use it to think about heterogeneous factor models, all in a data-driven manner, rather than humanly labeling them as, U.S. equity versus Chinese equity, bonds versus equity markets. Here, you can let assets self-group, and then you can figure out heterogeneous factor models. And more recently, we've been looking at the heterogeneity in predictability. Some assets, some clusters of assets are just more predictable in terms of returns, and that translates into trading profits. Again, those are not my main focus. My main focus today is to continue that route of heuristic search using reinforcement learning, but apply it to corporate finance. So we call it a data-driven robust control approach. And this is something we've been working on since 2020. Our Cornell server is not bad, but it's not particularly fast either. So it took some time for us to get to the results. So what is the economic question, right? So we shouldn't just pull the model off the shelf. In fact, we build the model ourselves, bottom up. But we still need to think about what is the relevant economic questions. Let's think about corporate finance research so far, right? Recently, there are several articles pointing out the bottlenecks that we face, right? Current corporate finance models do not explain or predict firm outcomes well, right? In sample, we do maybe 10% cross-sectional R-square, and it's worse out of sample. You ask CEOs, CFOs, how many of them use our corporate finance models other than CAPM or three-factor models to calculate cost of capital, right? And there are other issues, right? There's the potential for p-hacking and all that, just like asset pricing. And most of the corporate finance theory models tend to be piece by piece, right? There's some mechanism that we want to focus on, which is fine. We understand the mechanism. But when it comes to empirical tests, we typically just pick a few variables related to that particular theory in a very partial equilibrium reduced form test. In fact, that's not very strong in discriminating across theory models. And at the same time, we do know there's abundance of data in corporate finance settings. And AI has been effective in many other fields. So the idea is, can we tap into that to answer some of corporate finance questions? Now, in this figure, I'm just listing our existing approaches to corporate finance, right? And let's start with the dual goal of building a model, economic model. On the one hand, we want to understand the underlying economic mechanisms. On the other hand, we do want the model to be effective in explaining outcomes, predicting outcomes, providing counterfactual guidance, policy guidance. So I think reduced form models, whether it's causal or not, do a great job in understanding the underlying economic mechanisms. But the issue is, typically it's very low dimensional, right? We're very just one policy parameter. And the identification and all that come in a parameter range that may not be the current environment, right? Managers are making high-dimensional decisions, combinations of actions in a constantly evolving world. They're learning about the environment. And they might have to make decisions outside the parameters where we had that causal effect identified. So it's a little bit harder to produce counterfactuals and predictions. Structural estimation try to take a more balanced approach. It's modeling holistically the entire system. So the counterfactuals produced are actually causal if you believe in the model. But structural estimation typically has to start from a restricted modeling space, namely theoretically tractable models, where you have to assume the transition probabilities across states when you do the dynamic programming, so on and so forth. So what we are trying to do here is essentially a data-driven version of structural estimation using reinforcement learning and deep learning, so that we can do very well in terms of prediction, in terms of explaining outcomes, in terms of producing counterfactuals. We don't do well in understanding the underlying economic mechanisms, but to that end, we do have some arguments to our defense. Number one, we uncover new patterns that could help theory work and reduce form of structural estimations to explore further. We also, as you'll see later, try to incorporate stochastic control concepts, which would enable us to understand somewhat what are the boundaries to a data-driven approach, along what dimensions, for what type of questions, having enough data and computation would be sufficient, and in what other situations the algorithms, the data-driven approach is just not going to work very well. And those are the areas where theory, reduced form, and other approaches should focus on. And I think that provides some guidance on how we piece together different approaches, different models within corporate finance research. And there are many other reasons why we take this reinforcement learning framework. For example, there's the market feedback literature talking about how managers are learning constantly from the market environment. But safe to say that corporate finance problems, at least in practice, and because it's so in practice, I think in terms of modeling them, we should think about this, is that it's fundamentally a stochastic control problem, right? Managers are making dynamic decisions. They try to come up with a policy to optimize some objective, maybe market cap, maybe enterprise value. And action space is very high dimensional. And they don't know the environment. They're constantly learning from the environment about the transitions of states of the system. So it's really a robust stochastic control problem. And in the interest of time, I'm not going to talk about the details, how we add to the literature, but this is a new approach for corporate finance. I think it complements the existing approach, and it's also a non-text-based application of large model to corporate finance. I think it's probably the first non-text large model in corporate finance. And in terms of contribution to robust control literature, most of the robust control studies have focused more on the theory side. This will be an empirical data-driven implementation of some of the robust control concepts, right? Such as ambiguity aversion or minimizing DL divergence, right? Adding some penalty if the model is uncertain. And then of course this adds to this agenda that I mentioned earlier, goal-oriented search as a theme in modern AI, which can be applied in finance to answer various questions. So without further ado, let me delve into the details. Again, we are not enlarging the data set. We're taking the typical corporate finance data set, which is already pretty big. Well, pretty big relative to what we've been doing in finance in the past. It's way smaller relative to other applications such as language or audio, video processing, image processing. That's fine. Typical standard resources of information. CompuStat, CRISP, right? We cover a few decades of data at quarterly frequency, just because some of the variables are not reported at very high frequency. And we have close, well, not close, 784,000 firm quarter observations. The state variables, we start with, I think right now we have 12. This might need update. The typical state variables of a firm. What do we mean by that? There could be internal states, right? On the accounting book, what's your current asset? What's your accounts payable, so on and so forth. There could also be states that come from the environment. What's the current inflation rate, interest rate, employment rate, all the macro variables that could potentially affect a firm. Those are also state variables. Market cap, right? That's coming from the market valuation. It's not fully just accounting fundamental from within the firm. And for macro variables, we just take Chicago Fed indices, which is quite simple to handle, composite indices. You can do finer job with more dimensions of macro states. That's fine. And for all these variables, we do count their historical path, right? For simplicity, you can just look at last 4 lagged observations and their growth rate. We look at both level and growth rate. That's the state variable. What are the controls for the manager, right? What are the decision variables? Well, managers can decide to raise new financing, can put it in R&D, they can do repurchase, they can change acquisition, they can do acquisitions and mergers. These are all decision variables. And we take the 9 most common, they are typically finance related. So this is probably more for CFOs rather than CEOs. These are the control variables. Overall, when we train the whole model, there are over 3 million parameters. It's not crazily over-parameterized, but it's definitely a large model. And in the finance setting, and the training takes some time, but I hope OpenAI people are not thinking about the same problem. Otherwise, they can do this in a week, whereas we took years to do this. So here's the basic structure of the model. There are at least 2 modules to AlphaManager. There are add-on modules that we can use to extend the analysis. But let's start with this basic 2. The first module is essentially a predictive environment module. In a way, we are trying to build a world model for finance, right? We want to say, well, if I take this combination of actions, how does the environment react? How would the state variables for the firm evolve? How would the market value my action, right? Depending on what my objective is. And that necessarily involves interpolation and extrapolation, right, from historical data. A natural question there would be, why can you do that? We know we can't really do that in reduced form models, right? You have causal identification. You can say, oh, far away from that parameter region, the I don't know, the elasticity or the effect estimated would still apply. We can say that. But how can we say that here? There are 2 reasons for hope that we can build such a model. One is we've enlarged the modeling space. We use deep neural nets. We haven't used reinforcement learning yet, right, for the environment module. We use deep learning structure. So we can extract more information. Hopefully we can extract more information from historical data that we do a good job in terms of predicting outcomes or predicting environment reaction effectively going forward. Number 2, we could have overfit. We could have data shifts, right? Distributional shifts. The environment going forward could be fundamentally different. So we can't say we fully solve the problem. But that's where robust control would be helpful, which I'll discuss in the next few slides. That would allow us to at least say, well, when these happen, when these are likely to happen, at least we can detect, oh, the model is actually uncertain. The predictions are not very robust. And we take cautionary measures, right? We try to avoid relying too much on these predictions. So that's what we're doing with the environment module. And I think building a world model for the physical world is very hard because the physical principles have to be satisfied. And for economics, right, for finance, well, we know there's no arbitrage, for example, as a principle, but it's not always obeyed. So in that sense, we are perhaps closer to building a world model at least in the financial world than in the physical world. That's one module. Given that environment, we can build a reinforcement learner representing the decision maker, the firm manager. And the idea is I'm going to take remember the control actions, right? The leverage decisions, so on and so forth. That'll be my UT, a set of decision action variables. And XD will be the system states. So I'm going to optimize over my actions to maximize a cumulative reward function, right? For a period of time, depending on our horizon, depending on the objective. And how do we optimize this policy? We use reinforcement learning. I try some action, see how the environment react. I fine-tune my action. And because my environment module is mostly built on historical data, this would be offline reinforcement learning, which is not as costly as doing surveys or going on active experimentation. You ask the CEO, right? Can you experiment this combination of actions just to see how the market react? They probably wouldn't quite do it. Well, they do it in a little bit, but not extensively or systematically. And the structure for the two modules are pretty straightforward. 3 and 4 layers of internal layers of neurons, respectively, right? With 300 and 256 neurons in each layer, so on and so forth. The training starts with 64 epochs, and once it converges, we continue to run 5 more epochs. Those are technical details that I don't think as economists we should spend too much time to discuss. Let's focus on what is helpful, right, for the economic aspects of the problem. I did mention we need to do robust control because we do have all these issues, right? There's risk, there's misspecification of the model, right? The environment model could be misspecified. Even if it's properly specified, the environment, the data coming in going forward might be different from historical distribution. We have to deal with all this. And luckily, there is a field of robust control. And in fact, more recently, economists have been applying it to, say, climate finance, for example. But over there, again, it's more from the theoretical aspect. So how do we do this empirically? The idea is we're going to train a set of environment modules, predictive environment modules. They are all deep learning based modules. The parameter could vary here and there. The structure could vary here and there. But the idea is these are all very powerful models to extract represent information. And so they could all work very well on the training set or even on the test set. But given a new data set, they might give very different predictions. If they all give very consistent predictions, and we know that neural nets can approximate most functional forms, that means we covered a good ground in terms of modeling space. They all give consistent predictions, then we are more assured, right? Relying on data and computation, we get very reasonable predictions that would do well out of sample consistently. We don't have to worry as much whether it's supply driven or demand driven because the outcomes are the same. But in other cases, they give very diverse predictions. That means the models are uncertain. The AI, the machine learning models are uncertain. They are not sure what they are predicting or giving. In that case, we can add some precautions, right? We can make the manager ambiguity averse, right? I'm not sure about which model I should use, so I should be careful. That's fine. We know ambiguity problems. We can also add some penalty, right? For example, if you look at this boosting arrow formulation, it's just one way to add penalty. So we're trying to predict the state variables going forward, the x hat, right? Maybe some model will predict a value that's higher than other models. We look at their difference. If their divergence is too big, that exceeds some threshold, we're going to activate a penalty function in the reward function that the manager is trying to optimize, right? Yeah, if you recall, right? The managers are trying to maximize the cumulative reward function. So that's kind of the framework we're going to use. I'm going to delve into some empirical results, and I was just checking the chat box to see if there are questions. Feel free to ask, clarification questions and all that. So here's the performance, right? We apply it to U.S. public equities. So let's look at the environment module. How does it do in terms of explaining or predicting firm outcomes? And here it will be predicting outcomes, right? Along all these dimensions that we care about in terms of fundamentals and market outcomes for a firm. When I say ignoring control, that means I'm not going to use the knowledge about the managerial action variables because they are typically reported with a lag. As outside investors, you don't observe that, right? With control means we use that information. And here is the test set is out of sample. And you can see on average, at least with control, we get to over 30, 40%. This is out of sample R-square compared to what conventional models would do in sample, right? About 10% in terms of explaining the cross-sectional outcome of firms. Ignoring control along certain dimensions, we do well. Along other dimensions, we don't. I think this is useful information because we then know along what dimensions we can predict better firm outcomes or explain better firm outcomes. And for the ones that we're not doing very well, maybe we need to think more about theory and other mechanisms that we can uncover. And also this is informative because this tells us along what dimensions managerial actions truly mattered. The managerial decisions affected the variation in the outcomes versus just looking at the past history of a firm, I can already predict its evolution, right? So that's an exercise. Think about the typical recapitalization exercise in a corporate finance book that we teach, right? A manager can recapitalize the firm. You can issue equity or debt, put it in cash saving or investment or R&D. If my goal is to maximize, let's say, enterprise value going forward, which one is going to be more effective? And here is just an illustrative example, right? Based on historical data, based on the environment model we trained, it turns out that issuing equity, either putting it in cash or investment, will be the most effective. And there are things that are really ineffective. For example, substituting equity with debt. Now, in the data, historically, maybe there are additional financial constraints that firms have to, recapitalize for whatever reason. That's not something we're speaking to yet, right? This is just a baseline kind of exercise to illustrate. Even though we're developing a high-dimensional model, we can still look at the typical low-dimensional issues that we've been talking about and see how this, environment model using deep learning would help. That's the environment module. There's greater heterogeneity than one can explore, right? Along certain dimensions, the explainability or predictability will be higher, for different episodes, pre-dot-com, pre-financial crisis, post-financial crisis, predictions would work differently. Small firms have higher prediction errors and standard deviations in the predictions. Market cap, enterprise value, and the first Chicago Fed index, they also have higher prediction errors during the dot-com and the GFC. Okay, that's about predictive outcome, right? Remember, we do have robust control. We can also say, well, to evaluate our environment models, we can also tell along what dimensions the models are more ambiguous, right? The 10 to 15 large deep learning models I train for prediction purposes might give me very diverse answers when looking along particular dimensions, right? For example, again, that first index has a higher mean and standard deviation in terms of model ambiguity. Fine, that's the environment, right? now reinforcement learning comes in. Right? How would managers make decisions? Well, you have to tell me the objective. And as a benchmark, we're going to use next quarter or next 2 years market cap or enterprise value as the objective of the manager. Now, you can give me alternatives. That's fine. We can repeat the exercise. I think these are reasonable benchmarks, right, to look at. Right. If you are looking at the next quarter market cap increase, you are probably a short-termist in terms of managerial style. In any case, over the short horizon, right, the performance in terms of market cap and enterprise value as objectives, you can improve historical performance once you use the reinforcement learners recommended actions by as much as 12%, which is huge. And you can say, well, wait a second, maybe historically these are not the right objectives. Managers are not thinking about this. We'll have more to say about that. But if this is the objective, then AlphaManager can definitely provide policy recommendations. And by the way, what I'm reporting is auto sample tests. Okay. And in terms of longer horizon, 2-year horizon, the improvement is also substantial for market cap and enterprise value as objectives. And the figures here are just plotting, because we are looking at a cross-section of firms, right? Some firm would benefit more from AlphaManager, others benefit less. So here we're just plotting the quartiles. And let's also think about long-term performance when the managerial objective is very short-term, right? If the manager cares about 1 quarter going forward, 1 quarter market cap improvements or enterprise improvements, how does it do over the longer horizon? Does short-termism really hurt? We actually find that it's true that short-termism doesn't help the firm to do well in the longer run. But that's more of the case for market cap when you are doing short-term market cap than short-term enterprise value. So these are some descriptions that we can get from simple exercises. Again, there's very rich heterogeneity one could look at. Along certain dimensions, the AlphaManager recommended actions would affect more versus less. Across different episodes, AlphaManager performance improvement would change. For example, what we find is that pre the financial crisis, the improvement is actually bigger, and post financial crisis, the improvement of AlphaManager is more limited. If I remember that correctly. Now, what type of actions are they recommending? Well, take the example of next quarter market cap as the objective. AlphaManager is relative to historical actions. It's recommending more acquisition, increasing cash holding, for example, keeping the same leverage, paying out more dividend, increasing investment, especially in R&D. And that tend to improve the objective, which is next quarter market cap increases. And here we're not trying to get free lunch, right? Certain accounting identities have to hold. And that's what's difficult in training this model, right? When you raise equity, you have to put it somewhere, right? Either in R&D or in cash holding. Certain accounting identities have to hold. And that's not something that most empirical corporate finance studies strictly enforce, right? When you do a reduced form regression, you do control for other things, but you're not particular on, okay, so if we raise financing through that issuance, where does it go? We're not too particular on, that accounting identity has to hold. But here we actually make sure, that those are imposed. And finally, I think there's a interesting concept to talk about, given that we do look at model ambiguity. So when we make recommendations for managers, when managers make decisions using existing data, It's not only about the average expected outcome that they care about. They also care about if I take this package of actions, what is the uncertainty associated with the outcomes, right? If the outcomes are very uncertain, maybe I'm not too comfortable with that. So in that sense, there's something like a sharp ratio, right? I want to perform well for the objective, but at the same time, I want to be certain that I perform well. So you can define something similar and then look at how the performance of either long-term objective or short-term objective over different horizons, how would they perform and what's the cross-section. So, in the interest of time, I'm not going to go into details. I'll mention one more thing and then I'll wrap up and then we can take some questions. So far, I've been asking you to give me a managerial objective, but in reality, we don't know. Managers could be maximizing their equity compensation, right? Their own equity compensation rather than enterprise value. They could be maximizing ESG objectives. They could be maximizing employee benefits, right? So one module that we can add to the framework is what we call a objective module. And we do that using inverse reinforcement learning. And here's the basic idea. You can use a revealed preference argument to figure out managerial decisions, right? For any given objective, if I know the optimal actions, and then we see the historical actions, assuming the historical actions are optimal, then they must have this combination of objectives, right? That's a revealed preference argument. Conceptually, it's straightforward. Implementation-wise, it's quite challenging. In this framework, especially with reinforcement learning, so essentially we're solving a min-max problem. What do I mean by that? Managers maximize their performance objective for a given objective. That's the inner optimization. And R is the reward. Remember, it's the reward. So UT is the real historical managerial actions. And GUT here would be what reinforcement learning is doing. But at the same time, if we want to argue that historical actions are really optimal, we want to optimize the potential objective combinations that minimize any discrepancy from historical actions, right? From the recommended actions. So that's the min-max problem. And we are in kind of high-dimensional large model, big data kind of environment. And machine learning methods are not particularly effective in solving min-max problems because typically you have to have the objective as a convex function or something like that. But luckily, again, we can borrow certain ideas from the AI development. And if you think about self-driving and many other AI applications, what people do when solving this type of saddle point problem is you can use a generative adversarial network, a GANs network. To do that, we have to add one more module, which is inverse reinforcement learner. That's the module basically written here to learn managerial objectives at the same time as we optimize a policy if that objective is given. So basically, we separate the min-max problem into two optimization problems that each can be solved in parallel, but they help each other to converge. That's why it's a generative adversarial network. What really matters is, you have to specify some candidates for managerial objectives, and then the problem becomes, what weights they must be putting on these objectives. What matters are the loadings, right? Not the reward, optimal or historical reward function itself. Because essentially, you can do a linear transformation of the reward solution, and that would be still a solution. In other words, this is half linear manifold class of solutions. That's fine. So the problem can be solved. It's just the training convergence takes time, and there's no guarantee that the model would converge. But we managed to get the model to converge. And from that you can learn about the weights. This is still work in progress. But over the past few years, we've gotten some traction. So just to conclude, and also discussing some other extensions of the model that I haven't been able to talk about in detail. One is how this complements, theory and reduced form or other structural models. Essentially, by looking at the ambiguity of the models coming out of the PAM model and its interaction with the reinforcement learner, you can figure out along what dimensions or decisions we should focus our theory or reduced form studies on. Right? Otherwise, you can always pick something to study, and these are very segmented or fragmented. But now data are telling us, right? There are certain things that a data-driven approach wouldn't be very effective. We really need more theory. We need to figure out what is the causal relationship, so on and so forth. So I think it helps to direct attention in these other approaches. And also the ambiguity also guides us on how to do transfer learning, right? At the beginning I mentioned, in finance, we may not have as large a data set compared to natural language. So can we learn from some other setting about a particular problem? And that's where the robust control ideas and metrics will be very helpful. And of course, it would be nice to have more interpretations and consistency checks, but with deep learning models, interpretation is typically challenging. Now to wrap up, so we've looked at deep learning plus robust control approach of building an environment model for corporate finance. Standing alone, it can already give us some useful insights through our typical exercises such as predicting firm outcome or recapitalization. Combining that with a reinforcement learner, we can actually produce effective counterfactuals for managerial decision making and optimize their policy without assuming that they know how the environment, how the world evolve going forward. So they can learn dynamically through feedback with the environment. And if we are willing to add one more model, inverse reinforcement model, IRL, we essentially form a generative adversarial network structure, and that can allow us to study managerial objectives. Overall, this will be a data-driven robust control version of structural estimation, right? Rather than starting from theoretically tractable models, we start with a bigger modeling space. Any model that would produce this historical data are admissible, right, in our search space for a good solution. And taking one more step back, this is one way of doing goal-oriented search through heuristic learning, namely reinforcement learning. And why reinforcement learning? That's what the AI field has been using. That's what's used in ChatGPT and all these large language models in any case. Self-driving machine translation, AlphaFold, AlphaGo. So it's natural to kind of take their architecture, take their concept, and really customize that for financial applications. And as I mentioned, interpretation is a challenge. Maybe the tree-based approach would be an alternative that can help. I'll stop here to see if there are questions I can clarify or answer.
Okay, great. Thank you, Professor Cong, for your very insightful research. So the floor is now open to the audience. I think there's a question from the chat box. Do you consider the role of the managerial characteristics in your algorithm, such as risk preference or personal style?
Yeah, that's a great question. So far, we just take whatever we can get from standard data sets, which typically don't include manager-specific characteristics. if you look into the heterogeneity, right,
no, we actually, with such an answer, so I'm only one dollar.
Of the outcomes, I think it's worthwhile to look into managerial characteristics. That's probably informative as well. Maybe for certain managers, right? AlphaManager would help more. And for certain managers, at least historically, the firm is more kind of manageable in terms of managerial actions affecting outcomes, right? If you are you have a very dominant managerial style, maybe that makes implementing your actions more effectively than other managers. I think it's very interesting. There's a whole bunch of additional exercise one could do in the framework. Do you have to use the particular, 3-layer neuron structure? No, it's just a general kind of conceptual approach. That's more data driven.
Okay, great, thanks. Any other questions? If you have any question, please unmute yourself or type it into the chat box.
And I definitely went through many concepts and results quickly in the interest of time. Happy to discuss further offline as well. I do think this is an area where, even though we call it large models, they are not as crazy as the large language models, which require a lot of GPUs to train. So this is still manageable for specific, research teams within economics, management, finance. We are not at a disadvantage relative to the AI or data science field in that regard. And in fact, I think the questions we've been asking in finance are important and relevant. So if we can answer them better ourselves, I think that's a meaningful endeavor.
Hello, Professor Cong. I have a question. Why do you think that? I think that your result reveals that the long-term performance of your model is not as good as the short-term version. And are there any causes for this difference?
Yeah, no, that's a great question. So I didn't get to talk about the details of that. So here's the idea, right? For short term, we are trying to forecast reactions over the next quarter. So the amount of ambiguity in the predictive model is limited. For the longer horizon, just as with any longer decision, it just becomes a harder task, right? Then if you look at the average predicted performance, counterfactual performance, in theory, long-term could do well. In practice, and in the metric that we are calculating, we are allowing the managers to account for the ambiguity, the risk, the ambiguity in the models that they are doing. So in that sense, that model ambiguity and just the fact that longer horizon outcomes are harder to predict in any case is going to hurt the longer term performance. Now, if you are asking about longer term objective, that's a different story, right? We're talking about we're talking about the performance horizon versus the objective horizon. I think over there one is not strictly dominating the other.
Okay, thank you.
Yeah.
Yes.
Hi, Professor Chong. I have a question. So I think your approach is very interesting and very cool, but I have a very stupid question. So if we so what's the advantage of your approach? Like comparing to like for example, if I give the ChatGPT all of the information and variables, the past history of a given form, and ask it to predict some important variables. So what's the advantage of your approach, compared to
Right.
using some large language model?
Right. In a way, it's an empirical question, right? Which model works better? I've demonstrated the performance here for our approach. We can try ChatGPT to see how well it does in terms of predicting firm outcomes or in terms of recommending optimal actions for the managers. I'm very pessimistic on that because ChatGPT doesn't think about this robust control. That's actually very important, right? Think about why these large models have been working so well. They focus purely on prediction problems, but the predictions that they are making are typically similar to what happened in the past. As soon as you ask ChatGPT some out of historical context questions, they actually give you nonsensical answers. Why? That's because these are large models. They overfit. And when you extrapolate or interpolate too much, they are not going to give you robust answers. And that's why we think robust control is actually very much needed, especially that managers might be contemplating about combinations of actions that they have not taken historically, right? Therefore, historical data is not a full description of what's going to happen. So you have to add some robust control to that. So that's one reason to believe this is going to work better. Another is, even though I've been seeing, these models are a little bit harder to interpret, this is still more transparent than ChatGPT.
Yep.
We don't know what's going on, what data goes in for ChatGPT, how they actually make the decisions. And you can ask them, right? Why did you make this prediction? They give you an answer. But do you trust that answer? You still don't know. But here, at least you train the model yourself. You can look into the model. The models are transparent. In terms of economic interpretation, there are various approaches to interpret deep learning models. I wouldn't say they are perfect, but they give us some information.
Yeah, thank you. Yeah, I agree with what you just mentioned. I think, there are some advantage of your approach, but I think one possible advantage of the ChatGPT is that it may use many public information about a given form. For example, someone asked some characteristic of some managers, right? That's maybe of course you can include that information into your approach, given that the data is a variable, right?
Yeah.
But I think maybe the ChatGPT, they can use some information from different sources, and then they combine all these different sources. But as you said, it's a black box, so we don't know how it makes some predictions. I think,
You mean in the pre-training, it's using other sources, right? Because in the fine-tuning, it's whatever information you supply, right, as a user. So actually, I think it's really a double-edged sword. I actually worry about whatever information it's using. Is that really ensuring or optimizing the accuracy? I don't think so. ChatGPT tries to generate linguistically sensible outcomes. They are not trying to maximize either enterprise value. And in that sense, I'm against general AI models for specific applications. If we have a particular financial application, we don't need to train a model that's a good financial analyst, at the same time, a good artist painter, right? We have a very specific goal. We need professional, relevant data to train it, rather than generic, wider, multifunctional models that we try to train. But that's just my 2 cents.
Yeah. Okay. Thank you so much. Yes. Thanks.
Okay, I find a very interesting question from the chat box. Do you think the USA would win in this AI competition?
Well, I mean, the US is already leading in the innovation and all that, but that's more concerning computer science, right? From computer science aspect, building larger models, building larger computation capacity, is that the only route? I think for entertainment, for creative writing, for general search engines, maybe that's the route. For answering specific finance questions, is larger models always the way to go? Right? We could try to incorporate knowledge that we have. We shouldn't give up on knowledge graphs completely. And economists have a lot to contribute. It's not only about the technical side, right? So in that sense, that battle has not begun. And that's why, I really think this is quite an exciting field that many of us can get into in terms of programming. This particular paper took some, building of the model bottom up, but in general, with the availability of large language models and all that, even the programming part can be done through AI or through professionals. There are firms that can help you to work with outsourced tasks in terms of training AI models. So in that sense, I think the ability to ask relevant economic questions and see where we add value would be useful, and that's what economists are good at. So I remain optimistic for that, whether it's happening in the US or outside the US.
Great, thank you. So I may have a quick question. So in order to enhance the interpretability of this approach, is it possible to integrate like this approach based on reinforcement learning and machine learning into like structural model and also even reduced form causal inferences? Because we also do like some channel analysis in structure model and also mediation test in reduced form causal inferences. So yeah, I'm just curious about like integrate the different methodologies together.
Right. Yeah, no, that's a great suggestion. I mean, it's a bigger question, right? Not only for this paper, in general. What you suggested makes sense. I don't know how exactly to do it. I think for non-causal type of interpretation, we just want to see which one matter more. Is it the second order term matter more? There are ways that people have been introducing, right, to see sharply value. And my co-authors and I have worked on polynomial sensitivity analysis that would give us some patterns. But to understand the mechanism, the economic mechanism, I really think, we should take that pattern and go back to theory and causal analysis. Can we do a causal analysis in combination with this? I think that might be possible. I think there are researchers pushing, causal machine learning, so on and so forth. I just haven't explored that as much. I find it quite challenging. Important, but challenging.
Thank you. So are there any other questions? So if there's no more questions, I would express our greatest gratitude to Professor Cong for sharing his very insightful research. I think it's also been a very highly enriching discussion in the last few minutes. And I hope that all of us would leave here today with a deeper understanding of the immense potential that AI holds for shaping the future of finance. So thank you, Professor Cong, once again for your presentation. And
Thanks
also
for having me
thank you.
here.
Yeah, okay, no problem. Thank all our participants today for your thoughtful questions and also all the engagement throughout the webinar. So this is the end of today's session. Have a great day, everyone. See you in the next webinar.
Thanks, Jerry. Thanks, everyone.
Thank
Thank
you.
you. Bye.
Thank you.
Yeah, bye for now.